Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our Q4 update and 2023 outlook. As we wait for everybody to just stream in here on the attendees section, we'll launch right into a poll as we wait for everybody to attend. A bit of a trivia here, which is, as we're still in winter, in the throes of winter here, with a bitterly cold winter, I should say, here in London. But let's go into our poll, which is what's Europe's sunniest city? You got three options there. We'll throw that in while we go through the disclaimers and introduction, and we'll let that play out in the meantime. So just before we dive into the actual agenda for today, a few housekeeping rules here. The webinar is being recorded. And the recording will be shared on YouTube and various social media channels afterwards. If you do have any questions, please put them in the Q&A section, where we'll be, doing our best to get to them in a timely manner. Please note we will have a dedicated Q&A section as well towards the end. Dropping any messages in the chat directly is public to everybody, so just keep that in mind. With that out of the way, let's just dive into those disclaimers for compliance purposes. So just bear with me. Information presented here is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Now, before we dive into what our key takeaways are for this session, let's just bring that poll up to bear once more, and we'll just share those results here. So Europe's sunniest city, according to our attendees, is Alicante in Spain by far, with 73% of the voters. And well, it looks like you guys are pretty spot on. Alicante is indeed the sunniest city in Europe there. Although I think Brian might say the French Riviera has better views. Perfect. So with that out of the way, let's move on to our key takeaways here, and what we'll focus the majority of this session discussing. Really, the key takeaways here are the economy is not the stock market. Bad news continues to be good news. More on that later. And a decreasing US dollar will actually let stocks and the global economy recover. Again, more on that as we dive right in. So we've got Brian here, in case you guys haven't noticed. But with that, Brian, I'm just going to throw some heavy-hitting questions right at you, which is, what's going on in the economy?
Well, it's been a tough year for the economy, and it's going to be a tough year. The question everybody has on their mind is whether we're going into recession. The good, clear answer to that is, by what are we defining are we? As a global aspect, no, we're not going into recession. We expect, 1.6% global growth this year. And it's between 1.6, 1.7. So we're definitely not going into recession as a globe, but regions are definitely going to go into recession. Expectations would be that, say, the US would go into recession by mid-year, and Europe and the UK might be a little bit sooner. But from that vantage point, we have to remember that the economy is not the stock market. At the end of the day, there's a correlation between the two, but we can have an upward moving stock market without having an economy that's growing in a robust way. And that's to where we really have to remember that good news is going to be bad news, and bad news is going to be good news over the next year or so, because inflation is still the biggest problem out there.
I'm just going to pause you there for a second, actually, if you don't mind, Brian. For our audience here, what do you mean by bad news is actually good news? Why don't you just dissect that for us a little bit?
Well, that's a great point, because essentially what we've seen in the last couple of months is a mass layoff amongst the major companies. We saw 10,000 from Microsoft, we saw 12,000 from Google, 8,000 Salesforce, Amazon, Facebook, upwards of 10,000 plus. These are high paid employees. The banks have finally started to lay off some employees, I think 3,800 over at Goldman Sachs. And we can keep on listing those. Now, normally we would say that that is a bad thing to happen for the global economy, because when people lose their jobs, they're no longer able to pay into the system. The contrast here is that we have to tame inflation. And it seems like the Federal Reserve has done just that. And by increasing interest rates significantly, essentially wage growth has not grown as fast as inflation has. And therefore, the assumption would be that demand side inflation would cool down. If you don't have a job, if you don't have those earnings to pay for things, you're not going out there and spending the same amount that you did. And the Michigan Consumer Sentiment Index, which is one of the great readings on how people view the general economy, is even more negative than it was back in 2008. And when people are so negative, their spending behavior changes, and that cools inflation, i.e., all of this bad news of the general economy is turning into good news that it's taming inflation, so that the Federal Reserve doesn't have to continue to increase interest rates at that same pace, i.e., letting the market recover. And potentially, some analysts are actually predicting that by end of year, we could be looking at interest rates reducing instead of increasing.
It's an interesting take in. I'm just going to throw up a really quick slide here, which is what has inflation actually done over the last couple of months, particularly in the US, at least, if we focus our efforts there. Hopefully everybody can see my screen there correctly. And, the last reading in the US came at 6.5%, which is right bang on with where expectations were set, which again is, quite a ways off the all-time high of 9%. And, estimates are that it'll continue in that direction there. As Brian pointed out, with those efforts by the Fed, and also tying back into the bad news is good news. If the labor market, I suppose, isn't as strong as many people anticipate, then, well, that spending power isn't there to, artificially stem up demand in that regard. Perfect. So we've gone through, the fact that bad news is good news. We've established why bad news is good news, despite, everybody wishing for it to be otherwise. But let's tie that conversation of inflation actually coming back under control, at least when it comes to the US region, and tie that on with what's going on with inflation in other parts of the globe, and how that could potentially shape out this year, Brian.
Absolutely. We've talked about inflation being a demand side issue on the state side, and more of a supply side issue when it came to Europe and the UK, just because of the energy debacle, especially linked to the war in Ukraine. Now, essentially, when that plays out, Europe, the UK couldn't really fight inflation the same way that the United States did. And that generally means that interest rates are much lower in the UK and Europe than they are in the United States. And that continued to push up interest rates on the US side. A basic carry trade would be, you borrow money on the side where you can borrow it cheap. You shift it over to some place that has higher interest rates, and you try to find the best of ways to hedge that currency risk in between with a forward contract. So if you're able to borrow money over in Europe cheap and transfer it over to US dollars and get a 1-year CD for 4 or 5%, all of a sudden that 10% that it costs you to go ahead and secure that forward contract becomes a de minimis amount of money. And if everybody's playing that in one direction, that pushes up the dollar. That's what we really had this last year. We had a good decade where everybody wanted to invest in the US from the vantage point of the stock markets performing better, to the last couple of years, the fixed income markets being that much more attractive, or just cash markets. Now, if interest rates start to move up in foreign currencies, as we would expect, and the US tops out and even potentially goes down at the end of the year, all of a sudden those carry trades are no longer profitable. So they'll begin to be unwound. In other words, if you can get 4% on a European 1-year bank deposit, you're not going to shift it over to the US to try to get 4% over there and need to have that hedge going back into euros. So we're expecting that in the next 6 months to a year that those interest rates will continue to come up over here to curb that inflation, and that will bring down the dollar. I think last week we got our last bank that actually came out with being negative on the US dollar. So pretty much all of Wall Street is negative on the US dollar right now. And that essentially is great news for the global economy, and even more so for the US stock market.
Right, I'm going to pause you there, Brian, really quickly, but why don't we launch another poll here and get a feel of the room on what the audience thinks will happen to the US dollar in particular. So we'll just launch this poll here, which is, will the US dollar go up, down, or stay the same in 2023? So go ahead and cast your vote there. And Brian, I want to get back to your point there on a weaker dollar potentially being great for the markets. And would you mind just elaborating for the audience here why a weaker dollar is potentially good for the markets?
Absolutely. This is so integral into how companies work in the United States. We'll use the S&P 500 as our baseline, even though there's well more companies out there. If we took the average revenues from an American company, 40% of their revenues come from abroad. So whenever the dollar is going down, all those revenues coming from abroad actually come in at a better valuation than they did the year prior. Now, if you're a tech company, if you're Amazon, Netflix, Google, etc., it's 60%. So for these tech plays, and the tech plays, what we have to remember is not only last year were they a big part of the sell-off, but essentially going into recovery, they are going to be influenced even more so than the rest of the S&P 500, and therefore they have more room to recover from the dollar coming down. So it all has to do with those U.S. companies, how much of their investments come from abroad, and why we would see that to lead to helping a U.S. recovery the further the dollar goes down. Mm-hmm. The second aspect is that a lot of countries and a lot of companies abroad are forced to take out their debt in dollars. This can be based on volume. This can be based on their, especially emerging markets. Their currencies might not be stable or might be pegged to the dollar anyways. Mm-hmm. So now if you have debt in a foreign currency, you're in a position that whenever you're having to repay and the dollar's going down, the cost of that debt actually goes down. So it can be advantageous both on the equity side from a revenue vantage point, or the debt side in paying off your debts and having those decreased costs.
Interesting. So we've shared the results there with an overwhelming 63% indicating that the US dollar will in fact go down, and 25% reckoning that it'll just go sideways. So it's an interesting mix there in that regard. Let's move along. You touched upon emerging markets there a little bit, Brian, with a weaker dollar potentially in the mix, and how that could provide tailwinds to those particular regions, especially given the fact that a lot of their debts are serviced in that US dollar space. But are there particular parts in emerging markets that are more attractive than others, and where do you have your eye on in particular when it comes to emerging markets? Is it the fixed income? Is it the equity side? And if it is one or the other, which region is jumping out to you?
So both of them have their certain attractive elements. Now, fixed income is actually looking like there's going to probably be some more wobbles and instability in the near term. So it's probably a wait and see so that we can find good opportunities where things fall apart on the fixed income side. That being said, we might have missed the boat on India. Big news out of India the last couple of months, or we don't really know if it was the last couple of months or in a couple of months because everybody argues about it. But demographically speaking, China's population went down for the first time since the 1960s. And now India is, or will be in April, depending on whose news report you read, the largest country in the world. Mm-hmm. Now, that demographic trend is going to continue because the average person in India is, in their 20s, in their upper 20s. Mm-hmm. The average person in China is quite a bit older. I think it's closer to their 40s. Not that that's old. So all of a sudden, you know that that's going to continue to move in that direction where China's population will be decreasing and most likely India's population will be increasing. And that's the easiest way to grow your GDP is to grow your population. Right. Your productive population. Exactly. Absolutely. So all of a sudden, a lot of people have played into this trade that they're shifting around their emerging market allocation with all the negativity on China out of China, and they've jumped into India, because while they haven't been attracted by Brazil, they've been completely kicked out of Russia. South Africa has been a complete basket case. So of the BRICS, Brazil, Russia, India, China, and South Africa, all of a sudden India is that main play. Now, our problem with India has become that valuations of Indian companies are about the same level as American companies. American companies because they've come down, mm-hmm. Indian companies because they've gone up so significantly. And I'd love to be wrong on this because there's so much opportunity in India, but that feels really expensive to us. Mm-hmm. So we've reluctantly stayed away from adding to positions in India and building on that in fear that there's probably more downside in the near term than upside there. But that being said, China and Southeast Asia become great opportunities, not because we're saying that the political problems in China are going to go away, just because there's way more upside than the potential downside. The valuations compared to the historic valuations for the big tech companies in China are so cheap from that vantage point. With stability of currencies, we really need to be looking at South and Central America because that has become the agricultural hub of the world, the one that can really grow. And historically, that's what made America advance and grow so fast. And this is the opportunity for South and Central America to do the same at this point going forward.
Mm-hmm. So you mentioned there that, valuations, particularly in India, are quite outstretched, almost in comparison to the US, and valuations in China are still presenting, steep discounts, at least when you look at it on a longer basis. What sort of numbers are we looking at there on that spectrum?
Well, if we're looking at India, PE ratio, so the price to earnings ratio, as of today is in the 23 to 24 area. Mm-hmm. So all of a sudden we're getting some good valuations there. The S&P 500 right now is at 19.5, just to put that in perspective. So essentially that shouldn't be as close in those terms. Mm-hmm. India doesn't have the same level of stability that we have in US companies. And that's what makes me nervous.
Okay, interesting there. And just for those eager amongst us to know what the valuations in China are, as of yesterday, the forward-looking price to earnings ratios for the MSCI China index is actually 12.2. So again, that's half the valuation that you're getting currently from India. And almost just under half the valuations you're getting on the US side as well. And actually that brings me on into the other aspect, which is emerging markets as a whole. China makes up a large part of emerging markets, whether directly or indirectly, because it's a large importer of commodities, so therefore it has an outsized impact in that particular region. is China itself actually represented in the emerging market space or in the world index on an accurate basis, and is there further room there?
Well, I know you're itching to show this slide that you've got on the screen. So
let's pull that up.
Share it with everybody else. I think that's kind of the starting point. When you really look at the globe, we really concentrate on the U.S. because it makes up such a big part of world GDP, and even more so on world market cap. So what, according to this, the world's wealth, 31.5% of the world's wealth comes from the United States. When we look at it from a stock market vantage point, that's 57%. Mm-hmm. So this is why it's not because I'm so American centric that we really dig into these. Trust me, Cam pulls most all these slides and he's pulling the same things because it's so instrumental there. But you can see 18.4% of the world's wealth comes from China. It's number 2 on that list. And when we look at it from a stock market vantage point, it's not represented from an MSCI global vantage point, and it would make up, what is it, 19% if they actually included all the companies?
I think on a fully adjusted basis, it would be 19%, which, you know, when we have these discussions, it seems alarmingly high. But you know, that just happens to be the case right now. I think, especially if we take into account the A-shares market, which you know, international investors, I think for the most part have mostly stayed away.
And I think if you talk to most any analyst on Wall Street, if you're talking projections of 10 or 20 years, the assumption is that they're not going to be there. I'm sorry, they're not going to be excluded from that list. They'll slowly get inserted, whether it be through Western companies or whether it be by being listed and being added to the MSCI. Mm-hmm. So what we're trying to find is good opportunities to buy at good valuations. And that's where we're looking at right now. It can't be excluded from the world stage forever. Mm-hmm. Now, will it be added in the next year, next 3 years, 5 years? Right. Probably not. We're looking at a long-term vantage point there.
Mm-hmm. And we speak about the valuations there in emerging markets, but one of the other surprising things that jumped out to me, and I'm going to share my screen here, was actually coming back to the inflation argument there, Brian. Inflation was quite pronounced in the Western Hemisphere, right, and parts of the emerging market space, but emerging markets weren't as hard hit last year compared to a lot of the Western economies, which I don't know about you, but that surprised me quite a bit because that was a bit of an anomaly. And we'll throw up the charts here of what I'm actually referencing.
We're going to ignore Turkey, right?
We're going to ignore Turkey. Turkey is always a bit of a basket case for a number of reasons.
And Argentina is always a basket case too.
And you have your usual suspects there. But out of the usual suspects, one of the things that jumped out was, you know, the fact that last year at one point, Brazil had lower inflation figures than much of Europe. You know, same thing with China and Japan. Japan, not really emerging markets per se. And even India to some cases, you know, 6.8% compared to a lot of the Western parts there. Again, going back to that argument, do you think the inflationary dynamic also could potentially have some positive attributes there to those particular regions when it comes to the valuations and where we should be looking?
Absolutely. I mean, when we look at the war in Ukraine, the net beneficiaries were China and India on cheaper energy. That is definitely a shift that was had. China also had the zero COVID policy, which kept people from spending. People aren't spending, naturally, it's hard to move up inflation.
Right.
So now that we've gone off the zero COVID policy, we might see a little bit more, but probably not because supply chains are coming back online. We've got to remember at the beginning of last year, we were really talking about there being 4 real drivers to inflation, and 3 of them were transitory, and the 4th one was demand driven, and that one just kicked up in gear as everybody got out and was able to spend. Mm-hmm. China has a few more everybody's than the rest of us, for lack of better words. And therefore, it will be the question to see how they actually go out and spend that. Now, the reports I've been reading are that essentially the number of deaths is catastrophic, and that's actually keeping people at home and scaring them that little bit. But as things get back normalized, whether that takes 6 months or a year or whatever it might be, I'd expect, first of all, their economy to do better, and all of a sudden that inflation hopefully will be able to be controlled by the other three aspects being more transitory.
Interesting. And given that we've just hammered on inflation so much, I think that's a great segue into our third poll here, which is the US inflation pop quiz. So again, what item actually went down in price last year in the US out of these select few items here on your screen? So we'll answer wisely. And
I'm kind of disappointed that you didn't include potatoes. I've been on a potatoes kick when it comes to the commodity market, and just to entertain you in between, the conversation when it comes to commodities is not your typical what's going on in commodities, but instead the 110,000 items that are in your average grocery store. And to me, there's three items that kind of jump out inside of a grocery store. There's essentially blueberries are the item in the grocery store that historically have grown the fastest with inflation. No idea why. Right. Potatoes don't actually grow with inflation. And my assumption there is because they basically grow so easily that you can plot more when you want. You might have actual size deflation, but you won't have inflation in price when it comes to crisps or any other potato products. And then eggs end up being the one that grow with inflation. So I ruined your poll there by going through the eggs. But I'm disappointed not to see blueberries or potatoes on.
We'll have blueberries and potatoes for Brian next time around. But if we go ahead and share those results, we've got a 60% overwhelming consensus that smartphones were indeed actually the one item, or actually the two items of last year that actually went down in price compared to all the other items. And well, I think our audience hit the item right on the head. I'm just trying to pull up the actual results here on my screen. But
sorry, we've got an invasion of a dog right now.
Yeah, the dog seems to be getting into the way. There we go. Finally, we've got that up on screen. But no, everybody got it right. Smartphones plus televisions, actually, you wouldn't believe it, were one of the few items that actually experienced deflation in the US, which, it's a bit of a strange anomaly there, but I would imagine that has to do something to do with, I guess, part of the excess chips that were just left over at many of the fabs, and then all of a sudden having a much larger supply than demand was actually there to stand ready to deliver. But again, as Brian said, eggs, one of the few things, or top three items actually, that did have substantial price increases last year. So if you're in the market for a smartphone, now is probably a good time to go grab yourself one. Other items, maybe hold off on them. But yeah, perfect. We'll dive into our last section here before we hand it off to a couple of messages from our colleagues, which is, let me just bring that up here.
Which one are you trying to pull?
Good point. I'm just trying to get it up.
We've already got it. Okay, so why don't we jump into just predictions on the overall market?
Okay, let's do that while I sort out this technical issue here.
So all things playing out as we just discussed them. Dollar goes down and China reopens, to me, are the big themes that we're looking at for the year. China will keep the global economy growing at that 1.6, 1.7% expectation. As long as they stay opened up and that grows, we'll be fine from an economic vantage point. The dollar going down, which what we would expect is higher single digits or lower double digits. If that is the case, then we would expect good growth in the overall U.S. stock market. So that would be our average growth, 8 to 10% from that vantage point. That also being said, basically in dollar terms, all foreign, i.e. emerging markets and developed markets like Europe, UK, will reflect better in dollar terms, making them more attractive for those valuations. The UK is by most of the analysts still deemed as one of the most attractive markets. I think the government has to actually show signs that we can have a stable currency and a stable budget before I jump in and agree with that.
Stable government as well. We might as well throw that into the mix.
Absolutely. But Europe offers tons of attractive opportunities, and so do the emerging markets, which will show up even better with that declining dollar in those higher single digits. Fixed income will also show opportunities, but first on the U.S. side. As interest rates stabilize, we're probably 6 months to a year out before we'd be making the same determinations when it comes to UK or European longer term fixed income. So over kind of 2 years. If we're under 2 years, basically we're just holding it till maturity, but over 2 years, we would still hold off on that. If we're looking at a few more rate hikes at the beginning of this year and then potentially having rate reductions at the end of the year, fixed income might become very attractive by the end of the year. All that being said, if we're looking at a good balanced portfolio, we could be looking at a very boring and average year, which after last year, I will gladly take boring. I don't know about you.
I think after the last 3 years, we could all use some normal times. We've had anything less than normal over the last couple of years, which ties into our last question here before we throw it off to some messages from our colleagues on financial planning and various updates on the ESG space as well. So again, wrapping up 2023 market outlook, just getting a consensus here for the room. Do you think 2023 will be a good year for markets? Question. And then while we wait for everybody to answer that question, I'm just going to share this slide here really quickly. Actually.
Yeah, I don't think you have this one. I remember we talked about this a little while ago. The correlation of the Michigan Consumer Price Index to how the stock market does the year after. Mm-hmm. And I was just looking at it. It's finally recovering, but it basically, Michigan Consumer Sentiment Index went below what it was at in 2008. Mm-hmm. So it got down to 50%. So these are some extremely low numbers, and now it's finally starting to bounce up as the market starts to bounce up. Mm-hmm. So essentially, again, bad news, people being really negative about these markets. It's historically really great news for the stock market in the next year. So
I think the consensus has been, this has probably been one of the most forecasted and well seen recessions, so to speak, in probably since records began. And even if we look at sort of the global outlook by region, most regions for the most part seem to be overtly pessimistic for 2023. Unless you're a Chinese citizen, in which case you're the most optimistic at 50%. For this year.
Cam, I don't think everybody else is as young as you on this call. I think you're going to have to walk some people through this slide, because I'm sitting here wishing I had the smartphone and I could zoom in there.
Well, apologies for the clarity here, but we'll walk the audience through the slide here. So essentially, this is just showcasing a survey by different regions from the correspondents of just their viewpoints on whether they think there will be a global stock market crash in 2023. Now, you've got the various other years in 2022, 2021, and 2020, respectively, and really it just provides a sentiment gauge of the various correspondents in those different regions of whether they think this year is going to be a good year or not. So again, going off of that consensus, for the most part, a lot of the European regions seem to be overtly pessimistic. But if we look at some of the Asian regions, they seem to be in a bit more optimistic tone there. And again, if you're really pessimistic, you're probably in Malaysia at 71% of those quizzed in this poll actually thinking this year is going to be a pretty bad year. So Let's hope we've got no members of the audience from Malaysia here, because it's pretty pessimistic.
Playing into some stereotypes, it looks like of the European countries, France is the least negative. That doesn't sound very French.
I suppose it doesn't, but then again, this is a small subset. I think it's quite difficult to go ahead and get everybody's opinion across the whole country. With that, actually, let's just share the results of our poll here really quickly before we dive into messages from our team. So we've got a 61%, 60-40 split between do you think this year will be good or not for the stock markets? 60% saying yes, it will be good. 40% saying no. And I'm a little disappointed we don't have any people on the extreme ends thinking it'll be the best year or it'll be the worst year on record. Perfect. With that, I think let's hand it off to some financial planning tips from our colleague, Anya.
As we are coming to the end of the year, New Year's resolutions come to mind. These resolutions are often broken. However, we want to encourage you to keep As we are coming to the end of the year, New Year's resolutions come to mind. These resolutions are often broken. However, we want to encourage you to keep the financial ones. So giving yourself a financial checkup at the start of the year might help. With the inflation around the globe as high as it is, budget planning is definitely top of mind, and it's a great place to start. Now, in addition to making a spending plan, we recommend to also pay attention to your savings plan and pay yourself first. And of course, saving on tax advantage basis is key. So you want to make sure you have updated your retirement account contributions with the increased limits for 2023. For IRAs, those limits have increased to $6,500 per person per year, plus an extra $1,000 if you're over 50. So a total of possibly $7,500 if you're over 50. 401k limits for those of us that are lucky enough to have a 401k also increased. Currently, you can put aside $22,500 in 2023 into a 401k, and an extra $7,500 if you're over 50. So possibly a total of $30,000 for those over 50. Of course, not all of us are fortunate enough to have a 401k. For those of us who don't, just keep in mind that if you are an expat, you might still be able to contribute to an IRA. There are, of course, additional guidelines around it if you're living outside of the US, but we can certainly help with that. So do get in touch and we can help you through it. Another important topic as far as retirement accounts is if you have kids or grandkids who have earned income, definitely talk to them about starting to save early and maybe set up a Roth IRA for them if they qualify. On a separate note, if you are retired and you are taking distributions out of your retirement accounts or any other accounts, beginning of the year is a great time to review your income needs and decide which accounts to take distributions from to keep your plan as tax efficient as possible. Lastly, if you have any debt, especially any debt subject to variable rates, be sure to review it and make a plan. And of course, speaking of making plans, if you anticipate having any major life events in the upcoming year, please be sure to let us know so we can help you plan for it.
Perfect. Thanks so much for that, Anya. Some wise tips there for the 2023 year and beyond, and tips you can take for your financial planning needs. Next, we've got some updates on ESG from the European Union with Isa. So a short message from her.
I would like to give you some more details on the categorization of funds in the EU. The EU has launched a regulatory framework called the Sustainable Finance Disclosure Regulation, SFDR, which helps investors to better understand the ESG characteristics of funds or what their sustainable impact is and how they deal with sustainability risk. There's 3 categories in which funds can be categorized. There's Article 6, which really applies to all funds in the market, because that determines that fund managers should disclose in what way they handle sustainability risk and how it affects them. Article 8 is for funds that are promoting sustainability, while Article 9 affects all funds that have sustainability as a very particular goal. So based on those brackets, funds can categorize them in a certain way to help investors identify what their ESG characteristics are. Now, how does that affect you and your portfolio? Whether you're interested in investing in particular ESG funds or not, the effects are quite wide-ranging. This year, for example, there have been billions of dollars or euros flowing in and out of funds because fund managers that classified certain funds as an Article 9 fund have reconsidered the categorization to Article 8 due to upcoming regulation changes in early 2023, meaning that certain investors have invested in an Article 9 fund, and when they learned that now the fund is classified as Article 8, have divested their funds. So of course, this affects the overall market. So from that vantage point, the effects are quite wide-ranging. Also, in the longer term, and even now, there is a better determination in what kind of fund is an investor investing in. And if investors are really interested in investing in something sustainable and environmentally friendly, for example, this framework gives an easier way to identify what funds are investing in from an ESG vantage point. And lastly, of course, the regulatory framework also has an exemplary function. The EU has been the first regulator to really put something like that in place. And it's very likely that other regulators across the world are going to follow suit sooner or later. So yeah, from that vantage point, it is kind of a first we're seeing in the ESG space. And we're going to most likely in the following years hear more news on that also from other countries. Now, if you are interested in what kind of funds or what the classification of the funds in your portfolio is, please don't hesitate to reach out to us. We're happy to discuss that with you and look into your portfolio from that vantage point in more detail. Thank you and have
Perfect. Thanks so much for that message there, Isa. We'll move on to the next one, which is fixed income opportunities here. And so hopefully we can get Josh, our resident expert, on here. We've had Brian talk a little bit about interest rates potentially, going down a little bit towards the end of the year. But what are rates doing right now, Josh? And where are some of the opportunities in the bond market for clients and investors?
Yeah, definitely. So yeah, as you might have noticed, so I'm live, I'm not recorded. So I figured this way I don't have to hear the sound of my voice, and Cam doesn't have to hit the play button. So it's just fair that way around for both of us. Cool. Yeah, thanks for that, Cam. Basically, so most of you probably know me. If not, I'm Josh, and I do the fixed income trading for us here at Dunhill Financial. Brian and Cam touched on a lot of great aspects relating to the fixed income opportunities out there. But basically, just to reiterate a bit about what they were talking about, there are some great opportunities in that the rates have moved pretty favorably over the last several months, given how 2022 has gone. I talked about a lot about this in one of our recent webinars as well, so I'm going to be recapping some of that. But the basic idea is if you have some cash sitting on the sidelines that you will not be needing for the next, say, 6, 12, 18 months, some sort of time frame like that, it'd be great to get in touch and have a chat about what you might be able to do with it just to put it to work. So corporate bonds, whether it's sort of that route, if they're sort of investment grade bonds and such, those have been doing pretty well in terms of the rates available, somewhere between 4 to 5%, maybe a bit more, depending. That said, if corporate bonds are still maybe a little too risky for you, might consider something like CDs. And those are FDIC insured up to $250,000 on the U.S. side of things. So that's one of the reasons why it can be attractive to a number of people. Now, again, I should just reiterate that you'd want to make sure you don't need that cash. Just that it might be sitting there, not doing anything, might not want to put it into the market. That's another sort of thing we can just sort of look at. So feel free to get in touch about that. I've seen CDs be up to like 4.5. I think the highest I've seen lately is 4.65, which, I mean, if you know much about CDs, that's pretty good, right? So just another thing we can do. If you're also doing any sort of dollar cost averaging, if you're familiar with that sort of strategy of spreading the risk out over time, that's another thing that we could take a look at while that cash is sitting there waiting to get invested. Could also make sense to put that to work, but kind of stepping onto Cam's territory when I say this part, but you'll be getting contact details from us after the webinar. So if you do want to have a chat about that, if you have some of that spare cash, whether it's in dollars or euro or pounds, we can look into some of these opportunities, not just on the US side. Like Brian alluded to, something in Europe in the near term might be feasible, but I'd be happy to have a chat just to see, learn a bit more about your situation and what your cash needs are, and we could take it from there.
Perfect. Thanks so much, and hopefully you'll stick around here with me for our Q&A session.
If you ask really nicely, I can.
Yeah, just this is me being as nice as I can. We'll jump right into the Q&A section here. As Josh alluded there earlier, we will be sending out a follow-up email to all the registrants and attendees as well. You'll also have the more detailed slide deck, which again, we didn't have time to cover all the topics at hand on that docket. And again, we'll also have the contact details there as well, as Josh mentioned. But in the meantime, let's jump right on to Q&A. We've got a question here, more than a question, but an observation. The magnitude of layoffs is small versus the magnitude of hiring during the pandemic. So it's not as bad as that sounds. Now, that's actually an interesting point there that Philippe raises. Now, when we look at all of these numbers, you know, whether it's Microsoft laying off 10,000 employees or Google with 12,000, the numbers might not seem like a large amount, right? But at the end of the day, they're still, you know, close to 10% of their global workforce. In some cases, 12%. In some cases, we've seen upwards of 15 to 20%, depending on which company you're looking at. Now, the run up to the pandemic and you know, the sort of hiring spree that many of these tech companies went on, yeah, that was quite pronounced. But we've got Brian here as well to give his viewpoints on that.
I didn't mean for you to stop. I was just edging up to give a different perspective. One of the things that you also want to look at, it's not just what you've seen on the front page of the newspapers, and you're spot on, Philippe. For instance, I was looking at Salesforce just the other day because Elliott made a big acquisition of shares in shares in Salesforce. Now, pre-pandemic, they had 49,000 employees. Now they have 80,000. Now they're laying off 10,000. They're still net 21,000 employees. But what was interesting about Elliott taking activist shares in Salesforce is that it really pointed out how many activists activities are going on. There's right now 177 going on. Metro Bank is actually getting a big push right here in the UK. But Disney, big name over in the States, yep. Etc. And typically when these activist investors come into place, they like to really push and reduce costs in a heavy way. So I expect this just to be the beginning of the layoffs of these major companies to try to make it as accretive as possible for revenue growth or reduction of expenses amongst these S&P 500 or global companies, because the activists are coming in stronger than I've ever seen in my entire career.
But I'm just going to push back on that a little bit, if you don't mind, Brian. But you know, especially when we've seen these activist investors take, you know, prominent positions in some of these companies. Short term, you know, they're pushing for those cost reductions, etc. But longer term, there's actually a great piece from John Authors, if anyone subscribes to that, where, you know, longer term, those activist investors oftentimes, you know, stifle a lot of the longer term aspirations, longer term growth prospects of those companies, just to focus on the, you know, immediate now and then to make sure they get through. What are your thoughts there?
Wall Street can't see past the end of their noses. So this is not to say that this is what we're advocating. This is what we're going to see in the near term. So all of a sudden, what we're really looking for is unemployment numbers to increase. What we're wanting to see is wage growth decrease, so that essentially the Fed can behave in that type of way that we need them to in the near term. This is how Wall Street should look and how these companies should look over the longer haul, because that's something that each company has to deal with one by one. So I completely agree with that. Wall Street never can see past the end of their nose.
Interesting take there. We've got another question here from Philip. How will the difficulties negotiating on the US debt ceiling impact markets? Now, that's been always a topic of brinksmanship to the end. But what are your thoughts there, Brian?
The debt ceiling is this constant bargaining power between congressional members, and I think it's just kind of another one of those news items that will always be a pain to deal with, whether we deal with the $1 trillion coin or anything else. It's just something that we're going to be constantly dealing with until we get a resolution. We're not going to default on our debt.
Mm-hmm. And I think just to add to that, to what Philippe brought up, most of the time, every time we've come to these negotiations of raising the debt ceiling, it's always, for the most part, it's always been raised, depending on which side can get, as many back deal negotiations in alongside that. But regardless of whether you get, a technical default, quote unquote, with an asterisk there, there'll probably be some saber rattling and some short-term drama, but I think the markets oftentimes, as Brian said, they're used to the political theatrics there. Got a comment from Malcolm here. Brian seems somewhat ethereal today. Probably the lighting. We actually managed to get the lighting right, perhaps, unless that's in reference to something else.
I think I've watched Back to the Future one too many times in the anniversaries of it, and you get to fade in and fade out. Okay. Yeah. Sorry. I'll try harder, Malcolm. Nala is misbehaving as usual, so we're trying to keep her distracted back there. Mike has taken on a new role as the dog carer right now. I think Mike's dad is here too, so we can say hello to him as well.
We've got another comment plus a question thrown in there from Richard. A market analyst we saw recently said that the gas price in Europe has already collapsed because European governments have so proactively brought LNG. And the oil price is also falling. So surely inflation in Europe should be coming down fast.
There's two levels of that, and yes, those are all truths. But I think what was it? JP Morgan was putting out today that they expect oil prices to end of the year at $90 a barrel.
92, yep.
Yeah. So essentially, what really matters is that long-term number when it comes to CPI gauges and such. Now, CPI doesn't actually take into account oil prices because they typically do this, and yet they reflect in the price of everything else. And if you've gotten your heating bill, whether you're in the UK or Europe, you will notice that even though those natural gas prices have dropped down significantly, your bill has not. And I think we could spend an entire hour just on the reasons for that. Don't worry, it's not because everybody's out to get you. It's how these systems are built to try to take out some of that bumpiness and keep the energy companies in business. So essentially, that is one of the big gauges on there, but we don't expect oil prices to go back to the negative rates that we had back during the pandemic, like what we had for a short period of time.
And as we're flashing the various charts here up on the screen, just to add to that, I think the fact that Europe, we had first of all a mild winter here in Europe, right? It wasn't as severe as many people anticipated, and the fact that Europe proactively got ahead of that problem, I think they managed to save themselves a lot of headache, in sort of the medium term. Now, inflation in Europe should follow suit to the US, right? Again, the big question mark there is that geopolitical front, which is, do we get an escalation there, or do we sort of see things slowly but surely unwind? And that's, I think, the great overhang in Europe, preventing some of these prices, despite the fact that you're seeing, a lot of these raw commodities, but like Brian said, fall anywhere between 50 to 60%. You're not seeing that trickle through to the end consumer because of that geopolitical uncertainty there.
I like that you actually zoomed in on that one for us. I appreciate that. I was struggling on some of the other ones.
It's an interesting take though, because if we we'll give the audience here just a couple more minutes for questions before we wrap up. But one of the things I found quite interesting, and I'm not sure if you noticed this, Brian, but nuclear. Nobody actually talks about nuclear energy a whole lot when it comes to the renewable space, right? We talk about wind, we talk about solar, but nobody pays a whole lot of attention to nuclear, right?
Bill Gates did it up in his new book. If you struggled through that read, I think the Germans and the French have argued about it for years, and I think you can see the contrast between Germany and France right there. Mm-hmm. And for once, the French don't seem like the basket case when it comes to inflation. I think France has the lowest inflation in Europe, at close to 6%, whereas the rest of Europe is closer to 10%. And I think right there you hit the nail right on top of the head. Nuclear energy is the bigger mix when it comes to France, whereas it was winding down in Germany until all of this came into place. Mm-hmm. So it might become more of a conversation piece in due course, but they take some time to build.
Absolutely, they take years to build, and again, going back to the geopolitics and energy independence, I think that's where the European bloc as a whole has really found themselves in, which is, making sure that you're not reliant on one particular, nation, especially if it's an adversary, for most of your energy needs. And, as this chart points out, France has been somewhat well insulated compared to everybody else, with the lowest electricity prices on the continent. And then naturally that does translate to the lowest inflation figures from last year as well. 6.2%.
Did I get it right? Oh
yeah, you did. Pretty spot on.
No, I was just wondering if anybody else had something lower that was just a smaller market that I hadn't.
No, pretty spot on. France was actually the lowest inflation region in the European bloc. So again, energy independence. That's probably going to be the theme for the next couple of years, I believe. Perfect. I think we don't have any more questions, so we'll be wrapping up the session here. As mentioned, we will have a follow-up and a recording sent out in due course. So again, feel free to share that with your various friends and families, and feel free to circulate the material then. But again, I want to thank everybody for taking time out of their schedules to tune into this session here. And we wish you a wonderful afternoon. And thanks so much. Thanks, Josh, and thanks everybody else.